When it comes to investing, you win some, you lose some. That's just how it goes. But what if I told you there's a way to actually turn those losses into a win, at least when it comes to your tax bill? Well, today we're going to dive into a pretty neat strategy that does exactly that. It sounds a little counterintuitive, doesn't it? I mean, we spend all our time trying to avoid losses. But what if I told you that hiding inside those red numbers, there's a potential silver lining that could actually save you money? And the answer is a resounding yes. They absolutely can have a bright side. And that bright side is all about lowering what you owe in taxes. The strategy that makes this possible? It's called tax loss harvesting. Okay, so what is tax loss harvesting really? Let's peel back the layers on this thing and look at the core concept, how it all works. At its heart, the idea is actually super simple. Think of it like a seesaw in your portfolio. On one side, you've got an investment that's gone up. On the other, one that's gone down. Tax loss harvesting is just the strategy of selling that loser to help balance out or offset the taxes you'd owe on the winner. It's all about finding that balance. So here's how it plays out in 3 basic steps. First, you sell that investment that's down in value. That realizes the loss, making it official for tax purposes. Second, you sell an investment that's done well to lock in those gains. And third, and this is super important, you take all that cash and reinvest it to make sure your portfolio stays on track with your long-term goals. All right, so that's the theory, but it's way easier to understand when you see it in action. So let's walk through a real-world example to make this whole thing tangible. So picture this. You're looking at your portfolio. Your tech stocks have had a great run. They've gained a lot. But maybe your healthcare stocks, not so much. They've dropped in value. So you decide to make a move. You sell off some of those winning tech stocks, which creates a taxable gain. At the same time, you sell those healthcare stocks that were underperforming, which creates a loss. Then you take all the money from both sales and reinvest it to get your portfolio back in balance. And here's the payoff. When tax season comes around, that loss you took on the healthcare stocks can be used to wipe out the gain from your tech stocks. The end result? You could end up paying 0 capital gains tax on that big win. Pretty powerful stuff. But what if your losses are actually bigger than your gains for the year? Well, this strategy gets even more interesting. The IRS actually lets you use up to $3,000 of any leftover loss to lower your regular taxable income. We're not just talking about investment gains anymore. This is a direct deduction from your income. And it doesn't even stop there. Let's say your net loss is even bigger than that $3,000 limit. You don't lose it. You get to carry that extra loss forward into future years to offset gains or income down the road. It's like a tax-saving gift that keeps on giving. Okay, I know this all sounds amazing, but it's not a total free-for-all. Like with any smart financial move, there are some really important rules you have to play by. So let's talk about what you absolutely need to keep in mind. All right, here are the big ones. First off, this strategy is only for your regular taxable brokerage accounts. It doesn't apply to retirement accounts like a 401k or an IRA, because they already have their own special tax rules. Second, you have to match apples to apples. Short-term losses have to cancel out short-term gains first, and long-term against long-term. And finally, you have to steer clear of something called the wash sale rule. This rule is a big one. It's designed to stop people from gaming the system. Basically, you can't sell a stock to claim a tax loss and then just buy it right back the next day. The rule says you have to wait 30 days before or after the sale to buy back that same security or something substantially identical. So you got to be patient or just reinvest in something a little different. So after all these steps and rules, what does this actually mean for your wallet? Let's get to the bottom line and see the real world dollars and cents impact. Now this is the number that really makes it all click. In this scenario from our source, the total potential tax benefit from this one strategy could be as much as $8,050. That is a huge amount of money to save just by being smart about how and when you sell. Now, of course, there's a little fine print. That specific number assumes the person is in the 35% tax bracket and that they use the strategy to both offset gains and reduce their regular income by that $3,000 max. Your own benefit is always going to depend on your specific tax situation. And just 2 final, really critical things to remember. 1, even if you have 0 capital gains to offset, you can still use up to $3,000 in losses to lower your taxable income. And 2, and this is probably the most important thing, this can get complicated. So it is always a good idea to talk to a tax pro or a financial advisor to see if this is the right move for you. So as we wrap up, it all comes down to this question. Now that you understand the mechanics, the rules, and the really impressive potential benefits, is tax loss harvesting a powerful tool that you should be putting to work in your own portfolio? For any serious investor, that's a question that is absolutely worth asking.